Hello and welcome to Swag Academy. Terry Smith just bought Paycom Software and then added again to his position. Now he owns shares worth $64.7 million in the company. In this video, I will make an in-depth stock fundamental analysis of the company Paycom Software and analyze why Terry Smith found the stock attractive. I will cover its history, business model, growth, profitability, balance sheet, valuation, and finally do the 3M analysis. So make sure to watch till the end of the video. Let's begin. Paycom was founded in 1998, 26 years ago. Its headquarters is in Oklahoma City in the US. The company has $10.5 billion market cap. Its stock is trading around $181 at the time I'm making this video. Paycom is a leading provider of a comprehensive cloud-based human capital management solution delivered as software as a service. Paycom provides functionality and data analytics that businesses need to manage the complete employment life cycle, from recruitment to retirement. Their solution requires no customization and is based on a core system of record maintained in a single database of all HCM functions, including talent acquisitions, time and labor management, payroll, talent management, and human resources management applications. Their software enables employees to do self-management for their HR activities in the cloud, which reduces the administrative burden on employers and increases employee productivity. The Paycom business model has two revenue streams: subscription revenue, which is revenues it generates from fees it charges clients for subscribing to its main platform, and service revenues, which are revenues it generates from fees it charges clients from implementation and other services. Paycom grew its revenue from $151 million in 2014 to $1.69 billion in 2023, an 11x growth in 10 years at a compound annual rate of 27%. Simply amazing, so it is a growth company. Paycom is increasing their client base. In 2023, they had 36,820 clients. Their annual retention rate is around 90%. In other words, it is a sticky business, and they have recurring revenues every year from the same clients. This guarantees that the revenue will not decrease over the years, it can only continue increasing. Now let's check the profitability of the company. The gross profit is a result of revenue minus the direct cost to create these revenues. The gross profit margin is a result of gross profit divided by the revenue. The gross profit margin shows the amount of profit made before deducting selling, general, and administrative costs. The gray line in the chart represents the gross profit margin over the years. The gross profit margin is around 84%, which is extremely high, making this business a very profitable one. There are not a lot of businesses in our world with such high gross profit margins. Next, let's check the operating profit and the operating profit margin. Operating profit is a net income derived from a company's core operation. It is the amount of money that a company has left over after meeting its operating cost but before paying its taxes. As you can see, the operating profit is constantly increasing and reached $451 million in 2023. They only had one decrease in 2020 due to the pandemic. So operating margin is 26.6%, which means from every dollar revenue the company makes, 26.6% is operating profit. Again, a very profitable company and business model. Next, let's have a quick look at the free cash flow development. The same can be seen here. The free cash flow is increasing every year. It reached its peak in 2023 when the company had $293 million in free cash flow. Now, let's check the efficiency of the company. In other words, analyze the operating costs. The operating costs include costs for sales, general, and administrative, as well as research and development costs. Paycom operating costs grew with the revenue and reached 57% of the revenue in 2023. The company is investing money in sales and marketing in order to grow. Now let's have a quick look at Paycom's balance sheet. Paycom has $3.29 billion in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investment. The total current liabilities are the liabilities which the company must pay within 1 year. Paycom total current liabilities are $2.94 billion. Paycom total liabilities, including long-term debt, are $3.29 billion. By calculating the current assets minus the current liability, Paycom is left with $350 million cash on its balance sheet, making making the balance sheet extremely strong and healthy. Paycom can use this money to buy back stocks, invest in the company, or buy another company. Furthermore, Paycom have enough cash to pay its total liabilities, which is really good. Now let's jump to valuations. Paycom has a 6.03 price to sales ratio, a 22.23 PE ratio, a 17.67 price to free cash flow ratio, and a 7.17 price to book ratio. The PEG ratio is 0.81, indicating that the PE ratio is cheap for the growth the company is having. Pause the video and check how the current ratios compare to previous years. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downside, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering an 18% growth the first 5 years, a 15% the 5 years afterward, a terminal multiple of 16 and 15% discount rate. The intrinsic value of the stock is $136. Paycom is trading at $181, so the stock is slightly above the intrinsic value. I would like to mention that I made conservative assumptions for the stock growth and terminal multiple. Finally, the 3M analysis, 1M for moat, 1M for management, and 1M for margin of safety. Paycom has a strong moat. It is a sticky business and have a high retention rate. Companies that uses their software will not switch to another system. Management did a great job growing the company without debt and keeping it profitable. The stock is trading slightly above intrinsic value. The balance sheet is extremely strong. Now let's see what analysts say about the stock. Analysts' average price target for the stock is $193. Which is slightly above the current price. Most analysts consider the stock a strong buy, a few recommend to hold. In conclusion, Paycom is a great growing company with a great future. I will invest in the stock when the price is below the intrinsic value I calculated. What do you think of the company? Are you interested in buying it? Let me know in the comment section below. If you found value in this video, please give us a like, this helps a lot. Thank you very much for watching.